Hi value investors, welcome to my channel. Alibaba stock has declined something between 60 or 70% since October 2020. You know what happened in October 2020? The Chinese regulators decided to halt the Ant's IPO, which would have been, of course, the largest IPO of the entire history in the stock markets. And you know that Ant Group is an important fintech, an important subsidiary of Alibaba, in which Alibaba has 33.3% of participation there. Now, and when the new set of regulations, the Ant Group is in an ongoing process to be transformed to a financial entity. So you know that after that event of Ant Group, the Chinese regulators decided to start a new set of new regulations to affect the whole tech sector in China. That, of course, created a more bearish sentiment respect to these companies because the investment community didn't know how those regulations could affect the growth prospects of companies like Alibaba. But after that, in the year 2021, there were other risk factors that were emerging. For example, the possibility that the Chinese economy could face a potential recession because of the financial troubles of its real estate sector, and the investment community, investors didn't know how those financial troubles could affect other sectors in the Chinese economy that could end up affecting the consumption, which is one of the main drivers of companies like Alibaba. So all these events were pushing down even further the stock market price of the company. But then, of course, there were other risk factors that were emerging. For example, the possibility that the Chinese stock are delisted from the stock markets in the US because they are not fulfilling all the requirements set by the US regulators. And another thing that was concerning investors was the fact that Alibaba was using the variable interest entity as a legal form to trade its shares in foreign markets. You know that the Chinese government do not allow foreign investors to have direct ownership in Chinese companies' assets, particularly those assets that are located in China mainland. So Alibaba is using the variable interest entity as a tool to trade its shares in the stock markets, for example, in the US. Now, the thing is that, and why the investors in general were worried about that, is because when you are investing in a company like Alibaba, you don't have direct ownership of Alibaba's assets, particularly those assets that are located in China mainland. So this is completely different when you are investing, for example, in an American company, because you as a shareholder or as an investor, you have direct ownership to the assets of the company in which you are investing. So the thing here is that all these factors were contributing to generate more and more bearish sentiment respect to these companies. Not all was bad in the year 2021 for Alibaba. You need to remember that a super investor like Charlie Munger decided to invest heavily in Alibaba, buying more shares as the stock market price was declining, and until recently the stock of Alibaba really represent more than, something between 20 and 30% of the total daily journals portfolio. Now, just recently, we know, according to certain news, that the daily journals have sold 50% of the total position in Alibaba here. So this is the portfolio of the daily journals here, and you can see how the Alibaba's position has been reduced 50% here in the last quarter, but still it represents 15.35% of the total portfolio, which is a meaningful weight for a stock within the daily journals here. It is really unlikely that a super investor like Charlie Munger has changed his vision with respect to Alibaba. And of course, you need to recognize that there is a certain thing that we need to consider here, the reduction of the responsibility of Mr. Munger within the daily journals portfolio. He's no longer a chairman there. And of course, the entrance of the new management. With always a new management comes with the new ideas, new perception about risk and so forth. Probably the new management do not feel comfortable with the previous weight of Alibaba. Probably they decided to cut in half the position of Alibaba to take advantage of tax harvesting or any other. The most important thing really is that Charlie Munger hasn't changed his vision with respect to Alibaba, and the proof is that Alibaba still represents 15% of the total portfolio of the daily journals. And the second proof is, if really Charlie Munger has discovered that one of his assumptions or several of his previous assumptions have changed respect to Alibaba's business model, he would have recommended to the new CEO or to the new management to divest the entire position of Alibaba and not just the 50% as it is the case right now. So really, we don't have to worry about that, and we need to focus in all the characteristics that makes Alibaba special. Because of course, Charlie Munger only likes to buy outstanding companies that are trading at a discount. So, and in order to find out, and of course to answer the question why really Charlie Munger decided to bet heavily in this company, we will explore a little bit more about the business model after the regulations in 2020. And I will show you what are the metrics of this company, and I will compare with those metrics of its closest competitor, JD.com, in the e-commerce sector. And then in the third part, I will try to calculate the intrinsic value of this company using two different approaches in order to see what could be the fair value of this company in the long term. And in the last part, I will talk about the intangibles of this company. I will try to explore the vision, the mission, the way in which Alibaba manages its human resources to attract and retain talent. So there are different kind of things that are beyond the numbers that could help us to explain why a super investor like Charlie Munger decided to bet heavily in this company and not buy other Chinese companies. So I will start right now. This is the Alibaba ecosystem here. You can notice here that there is a different business line like the core commerce, the digital media and entertainment, the innovation initiatives. Then we have other different businesses, the consumer services. We have the logistic arm like the case of Kanyao here, Alibaba and Group, and Ali Cloud here. So it is important to notice that the core commerce is the most important business line of Alibaba because it represents more than 80% of the total revenues here. And well, of course, it generates most of the free cash flow generated by the company comes from this important business line here. So we could identify within the core commerce all the e-commerce platforms and other kind of business more oriented to China, and other e-commerce platforms and other businesses more oriented to outside China here. So just looking into the business oriented to China, we could highlight the Taobao and Tmall, which are the most important e-commerce platforms of Alibaba here. And well, the company, these platforms have something like 900 million active users, and if you notice, the number of people in China is something like 1,400 million people. You can realize that there is not so much room to grow in terms of number of active users. But of course, the strategy of the company is to increase the amount spent per active user. So this is important because the company and the management want to do that, just offering different added value services, and of course improving the experience of the active user with the platforms and with the different services offered by Alibaba in general. So really, Taobao and Tmall are critical here, but of course there are other important businesses within this part of the core commerce, like Sun Art and Freshipo, which are of course which are physical stores here. So some bearish analysts were saying that these Sun Art and Freshipo are contributing to generate lower net margins because, well, you know that these kind of businesses have, by their own nature of their respective businesses, have lower net margins. But of course, the strategy of the company is really to generate a better synergy between the offline and online services, and that way create more added value services that give the incentives to the customers to spend more in those services, and in that way could compensate in a way, at least partially, the lower net margins that these companies, Sun or Freshipo, are generating here. And then we have the other part is the cross-border global retail commerce here, and we could highlight the case of the AliExpress and Lazada here. AliExpress is an e-commerce that is more concentrated in Europe, particularly in the east of Europe here. So in these e-commerce platforms, really Alibaba has the opportunity to generate a sustainable growth for the future, because in these countries, many of these countries have a direct access to the goods and services or products offered by the Chinese manufacturers, and AliExpress just offered this opportunity to those markets. So the competitors, I mean the local platforms in those countries, and even Amazon cannot offer those services. I mean, cannot offer that access that AliExpress is offering to trade with the goods and products of the Chinese manufacturers. So that could be, of course, an important advantage of AliExpress, an important opportunity to generate sustainable growth here. And in the case of Lazada, it's a really interesting e-commerce platform because it is more concentrated in the Southeast Asia. You know that in those countries, I mean Vietnam, Thailand, Malaysia, and so on, all these countries have a lower penetration in the e-commerce platform. So there is a lot of room to grow in those countries here. So this is another source of future growth for Alibaba here. So this is the case of the core commerce. And well, we have another interesting business that we could highlight here, like in the case of Cainiao, which is an important logistic arm. The Cainiao support all the logistics infrastructure, logistic operations of the different e-commerce platforms that Alibaba has in the core commerce. So as those core commerce e-commerce platforms expand their operations, Cainiao will expand as well its operations. And well, we have another important subsidiary, like the case of Ant Group. You know that in October 2020, the Ant IPO was halted by the Chinese regulators, and we don't know when there could be another Ant IPO in the future. But of course, when that happened, it could represent an interesting catalyzer for Alibaba stock here. So, and of course, you know that Ant Group is in an ongoing process to be transformed to a financial entity as part of the regulations. And well, we have the Ali Cloud here, which is another interesting business line because Ali Cloud, I mean, is taking the leadership in terms of market share in China. So it has a lot of room to grow in China because well, China is in a process of digitalization. So Ali Cloud is contributing to this digitalization of the medium-sized companies and big corporations there. So in this chart, we can see the evolution of the market share of Alibaba in the e-commerce sector in China. And well, we will focus just in the past from 2014 to the year 2021. We are not focused here in the projections because the projections can be different among different analysts here. So the thing here is that just focusing in the past, we can see that the market share of Alibaba has been declining a little bit, and this is because there has been a strong competition in this sector. Something that we need to remember is that the Chinese e-commerce is a mature market, so there's not so much room to grow in terms of new active users. So the main driver here in this sector is to increase the amount spent per active user. That would be the main driver to deliver long-term growth in this sector. And Alibaba has the upper hand here because Alibaba is the company that generates more free cash flow as a result of its own operations in the e-commerce sector here. So if you have a company that truly generates more free cash flow over revenues here, you will have, I mean, you as an Alibaba, you will have the opportunity to reinvest more money than your competitors into your own business to reinforce your market position, to strengthen the engagement with the active users, to reinforce your position with the customers. I mean, there are lots of things that you can do when you are getting more money from your own business here. So this is something that is overlooked by many bearish analysts here, and that is why this is one of the main reasons why Alibaba will secure its market position over the long term in this sector. So in this chart, we can see the evolution of the market share of Ali Cloud here since 2019 to 2021 here, and we can see that the market share has been declining a little bit, but this is because there has been a stronger competition in this important sector. But of course, the main difference between the cloud sector and the e-commerce sector is that the total addressable market in the cloud sector is really high. I mean, if we are talking about the e-commerce, for example, we are talking about a mature market, but here there's much opportunities to grow for all the players that are part of this sector here. So even with all of that, Ali Cloud has taken the leadership of this important sector, and of course it will have the more opportunities to continue to reinforce its market position because well, this business line of Alibaba is close to break even, so it is expected that in the following years this Ali Cloud will be able to deliver positive net profits, positive free cash flow, which of course will add more cash flow to Alibaba, and in that way, well, the Alibaba will have the opportunity to reinforce even more its market position in this important sector. So it is expected that the Ali Cloud will deliver double-digit growth for the next 5 years at least. So this is the breakdown in revenues here. Look at this, how the core commerce represent more than 80% of the total revenues here. The cloud computing just represent 8%, and then, well, you have the digital media, entertainment, and innovation initiatives. Both of them represent just 5% of total revenues here. So in order to see a little bit more about the breakdown in core in revenues, we can see that in China, in the Chinese commerce, e-retail, we have the more than 60% of total revenues here. But of course, I'm interested in knowing how much it represents the international business here, the international commerce retail and international commerce wholesale here. In this part, they are including the business like Lazada, which is more focused in the Southeast Asia, and AliExpress, which is more, all the e-platforms that are more focused in Europe here. So they have, of course, an interesting potential to growth here. And if we add this business line with the cloud computing, which represents 8%, we could have something like 15.2% of participation of these three business lines here. And look at this, how these three business line has evolved in the last 3 years here. They are increasing their participation because of course they are growing at a higher pace than the e-commerce in China. So this is really interesting to know that these three really promising business line are increasing in their participation over the total revenues of Alibaba here. And then, well, we have how profitable each of the business line really are, because, well, you have the core commerce here, which is the most profitable one, but you have the cloud computing, which is almost break-even here, which, I mean, it is expected that in the next years, the cloud computing will deliver positive net profits, positive free cash flow here. And something really interesting to know as part of the strategy that I mentioned in the first slide when I was explaining the business model of Alibaba here. In China, there is a clear strategy to increase the amount spent per active user. And look at this, if you divide just the revenues generated by the Chinese commerce retail by the number of annual active users here in China, you can see how the revenues per active user has been increasing in the last 3 years here. This is part of the strategy of Alibaba to continuously delivering growth in the e-commerce sector in China, despite the fact that this is a mature segment of the market here. So these are the metrics of Alibaba here. I just collected all this data directly from the financial statements of the company since the year 2014 to the year 2021 here. And in order to see how a company like Alibaba really delivered value for the shareholders is through the growth in sales here. The company has been consistent in this important metric here, and of course it is expected that in the future this company will see a deceleration in its growth, because we need to remember that the main business of this company is the e-commerce sector in China. But no, the company like Alibaba really not only growth in sales, but also it is really profitable. If you see here in the net margins here, how the net margins, I mean the net income divided by revenues here, the company was able to deliver more than 20% of net margins, which is really good here, which indicates that the company really is offering added value services. Well, the return of equity here, the company was able to deliver more than 10%, which is something that I like to see in a company. And the return of invested capital, of course, well, it has declined a little bit since the last 4 years. And the reason is because, well, you know that a company like Alibaba that generates so much cash flow, they need to reinvest all that money into, well, in new acquisitions, in new participations, in different companies, and some of those participations are not profitable yet. And taking into consideration as well that the recent acquisitions of Alibaba, like in the case of Freshippo or Sun Art, have lower net margins. That of course contribute to this relatively lower return of invested capital. But of course, for the future, this could improve, as Alibaba still is waiting for the cloud business, because, well, you know that the cloud business is really close to break even. So it is expected that this important business unit will be profitable in the next years. Not only the company is growing well, but also in terms of the balance sheet, really, the balance sheet of Alibaba is really rock solid here. Look at this. In the case of the terms of the long-term debt and the net income, if you divide the long-term debt by the net income, you will notice that the company can pay all the long-term debt using the net income of the last year, the year 2021, in less than 1 year here. And of course, the company has an important cash in its balance sheet, $51.4 billion here, and of course it could cover entirely the total debt of the company. Look at this in terms of renminbis here, 321 billion here of cash balance could cover entirely the total debt of 149 billion here of total debt here. So really the company is really good generating cash flow and do not need so much debt to continuously operating here. And something that most people just forget about is the cash flow generation of the company. For me, in my humble view, this is the most important metric of this company, because well, look at this cash flow generated by the company over the years here. If you compare the free cash flow and you divide this free cash flow by the revenues here, you will have this important metric here. The free cash flow over revenues is in the last year has been 26%, which means that there's really a really high generation of free cash flow. So when you have a really an e-commerce sector with so much competition, the company that has the highest generation of free cash flow is the company that has the upper hand here, because in the case of a company like Alibaba that is getting so much cash, the company, of course, with more cash in its pockets, has more possibilities to reinvest in its own platforms, to reinforce its moat, to reinforce its competitive advantages, to strengthen the engagement with the active users and so forth. So there is more possibilities to create more added value services to the customers and to the active users, and in this way, of course, reinforce your moat and competitive advantages here. Now, something really interesting to notice here, well, is that this is a company, of course, that do not pay dividends, because all the money is used to reinvest into its own business, to make acquisitions, to reinvest into its platforms, and so forth. You can notice here that the outstanding number of shares in general has been increasing in general, and this is because of the compensation packages here. The company really needs to reward critical personnel within the company, to give the incentives. Of course, it is part of a common practice in the whole tech sector in China. All the companies are doing the same thing here, so this is not a surprise. But of course, these kind of things really give me some doubts, because you need to remember that Alibaba is planning to make 25 billion of repurchases of its own shares for the next 2 years. 12.5 billion for each of the next year. But honestly, you can notice here that there is just a 4% as a percentage of the worth of the company. So I don't think so that will contribute to reduce in a significant way the number of outstanding shares, particularly if the company is conferring this kind of compensation packages that implies that the company need to issue more shares to please these stock options or these new restricted units stocks and so forth, to reward the critical personnel within the organization here. And you can notice here that since the year 2014 until the year 2021 here, you can see how the company has not been consistent in the repurchases program here. Look at these repurchases respect to the free cash flow here. I don't think so that this new program of the 25 billion to repurchase in some shares will have a significant impact. But of course, it is a good signal to the market, a good sign to the market by the management that the stock market price of the stock is really cheap here right now. So these are the metrics of JD.com here from the year 2014 to the year 2020, and I just collected all this data directly from the financial statements of the company. I couldn't find the numbers of the figures for the year 2021. Apparently, the annual reports have not been released yet here. So, but we have enough data to compare the metrics with Alibaba here. So something important to notice about JD.com is that we could highlight the growth revenues of the company in the last years here. The company has really interesting prospects to continuously growing for the next years. But of course, and it will experience the same experience as Alibaba, because you know that the e-commerce market here in China is a mature market. There's not so much room to grow in terms of number of active users. So both companies, Alibaba and JD.com, are working, of course, to increase the amount spent by per active user here. So there's still some room, but not so much as some people may think here. But of course, in the case of Alibaba, you need to remember that there are other sources of growth here in terms of the international markets like Southeast Asia, Europe, the cloud business, and so forth. But in the case of JD, I should point out that this is a completely different business model here. In the case of JD, the business model really implies so much investment in infrastructure, in distribution centers. I mean, really JD.com wants to take more control of the supply chain management of the entire operation here. So really the company really needs to buy all the goods that will be stored and then will be distributed to the final clients. This is a completely different business model than Alibaba here. In the case of Alibaba, you should remember that Alibaba offers the platforms for e-commerce, but those platforms have the goal to connect the buyers with the sellers. So Alibaba do not have to buy the goods to offer to the final clients here. So this is a really interesting thing because Alibaba has a better flexibility in its business model. But of course, in the case of JD.com, really requires so much expenses. I mean, if the company wants to expand lower tier cities in China, well, the company really needs to invest so much in logistic infrastructure, logistic networks, and so forth. So the company really needs to spend so much money, more money than, I mean, the business model of JD.com required so much money than in the case of Alibaba. That's one of the main reasons why a company like JD.com has lower net margins here. Look at this. In the case of the net income over revenues here, in the year 2020 and 2019 here, well, you have lower net margins in here, 7%, 2%, whereas in the case of Alibaba, you have net margins over 20%, which indicates that the company has is really more profitable here. In the case of return of invested capital, look at these numbers. I mean, it is because the company really requires so much investment to continuously operating here. The thing here is that in the case of the return of invested capital of Alibaba, well, you know that the company is offering more than 8%, well, 8% or more. So this is substantial difference here for Alibaba. Look at this. In the case of JD.com, you can see that business model or that company as a heavy asset company, and in the case of Alibaba, you can see that company as a asset light company. So that means that there is a higher proportion of fixed costs in the case of JD.com. We could imagine what happens if China gets into a recession here. Say that JD.com will have more problem to adjust its costs because of the higher proportion of fixed costs here. Whereas in the case of Alibaba, Alibaba will have more flexibility to adjust its costs. In the case of a recession in which the people in general, the customers, we could demand lower services from Alibaba, lower services from the JD.com, Alibaba will have a better chance to adjust its volumes, to adjust its cost, and in that way not affect its margins. But in the case of companies like JD.com, which higher proportion of fixed cost, the net margins could be affected by a lower demand for the services here. Something important to notice about JD is that it targets the wealthier segment of the market. So this is of course the customers that are willing to pay more for the services here. And this is because, well, JD.com is focused in offering premium services with high quality products here. And of course the delivery takes less time than in the case of Alibaba, because this is part of these premium services. And probably in case of a recession, well, the wealthier segment of the market will not demand so much lower. So probably JD.com could be rather protected because they are targeting the wealthier segment of the market here. Anyway, I would say that Alibaba has the upper hand here because it generates better free cash flow. Look at this. We can see here, if we divide just the free cash flow over revenues here, in the last 2 years, Alibaba has been able to deliver 26% over revenues here, which is really good here. But if you take, for example, the JD.com, the company was able to deliver only 5%, 3%. I mean, this is really low. Okay, and this is because of the nature of its business model. Anyway, I consider that both companies could compete each other could thrive in the long term here because they are targeting probably different segment of the market. JD.com is more specialized to the wealthier segment of the market here. And then, well, something really interesting to know is that both do not pay dividends because both want to reinforce their respective businesses here because the competition is really strong anyway. In both cases, you can see that the outstanding number of shares has been increasing in the last years here, and this is because of it's a common practice the whole tech sector here to offer stock options and rewards for the critical personnel within the organization here. In the case of the repurchases over free cash flow here, you can notice that both of them has not been consistent here in the case of the repurchases here, because as I mentioned previously, these companies prefer to use all that money to reinvest in its sub-platforms to improve their services and to strengthen the engagement with the active users. But I would consider that here Alibaba has the upper hand here, has the advantage because of the free cash flow, the high levels of free cash flow that is generating the company. So of course, when a company like Alibaba generates so much free cash flow, it has more money to reinvest in its own platforms to reinforce its market position, to reinforce its moat here. So in order to calculate the intrinsic value of Alibaba here, we will need to have a forecast for the sales, at least for the next 5 years here. So just found this information here in Caven Investment from Seeking Alpha. They have made a very interesting forecast for each of the business unit of Alibaba here. For example, in the case of Lazada, they have made projections for each of the countries in which Lazada has presence. In the case of AliExpress, they have made a projection for each of the countries in which AliExpress has presence and so forth here. So it is really interesting information to be included in my projections. So look at this in the Chinese e-commerce, how the growth is expected to decelerate in the future. In the next 5 years here, we have the international commerce, we have the Canal logistics services, we have the local consumer service, we have the cloud computing, despite the fact that these analysts are rather bearish with respect to the future of Alibaba. They are really bullish in terms of the growth expected for the cloud computing here, really. And then, well, we have the digital media entertainment and the innovation initiatives and others here. Is that once we have all the forecasts for each of the business unit, we will add up all these projections of the sales expected for each of the business units, and we will sum all of them to calculate what will be really the forecast for the total revenues of the company for the next 5 years here. And this is the projections, this is the growth that I will include in my calculation for the intrinsic value here. So this is our first methodology to calculate the intrinsic value here. The first assumption that we will need to do is that we are assuming that we are holding the stock of Alibaba until the year 2026. So we are interested to know what could be the intrinsic value in the year 2026 here. So in order to do that, we will need to have the outstanding number of shares, and we will need to assume this metric, the free cash flow over revenues. I'm assuming 25%. You need to remember that in the last 3 years, Alibaba has delivered 26% in this metric. So we will incorporate the forecast that I just shown to you previously respect to the sales growth expected for the next 5 years here. So if we have the official numbers here, the revenues in the year 2021, we can calculate the revenues using the growth rate expected for the next 5 years, and we can calculate the revenues in each of the following years here. Then in the year 2026, we can multiply these revenues by this metric, the free cash flow over revenues here, in order to estimate what could be the free cash flow expected for the year 2026 here. Now we could divide this free cash flow divided by the outstanding number of shares, and then we will need to consider a certain multiple here of price over free cash flow expected for the year 2026 here. Look at the metrics here. This multiple, it was 9.5 in the year 2021, but previously it was 26 times, 34 times, 23 times. So you need to remember that in the year 2021, the Alibaba was middle of the crackdowns, in the middle of regulations. So of course the market punished the stock here. But then of course 12, I would say that 12 is really a really conservative multiple, considering that it would have been clear for the market how the regulations really affected the business model of Alibaba. So if the company continuously growing as expected and being profitable, it is really hard to imagine that the market will pay 12 times. I would say that the market will pay even more. But of course, I like to be conservative, and this is part of our margin of safety here. We will consider here 12 times. Then we will need to multiply this, and we will get our target price for the year 2026 of $272.37 per share. And in order to calculate what could be the intrinsic value right now for the year 2022, we will need to calculate the present value here. There are 5 years here. We are considering here a discount rate of 15%, considering that if you're investing in China, you would expect, for the higher risk, you would expect a higher return. So I'm really demanding a higher return here of 15% annual compound for the next 5 years in order to have the incentives to get into this company. Once we have this, calculate this present value, we could have something like $135.41 per share here. And if you want to apply another margin of safety here, you can get a price entry of $94.79 per share. So right now, the price right now is 95.49, which could be really attractive, really attractive, because we are considering here, we are incorporating a margin of safety and another margin of safety of 30% here. The margin of safety is incorporated here in the multiple that we are applying, and in the various forecast here of the expectations of the growth rate in sales that we are considering here. What happened, for example, if the market really determines that Alibaba, of course, probably the regulations affect the business model, but anyway, the company was able to deliver double-digit growth for all these years here, as it is expected. So most likely, the market could be willing to pay something like 18 times here. And look at this, the intrinsic value could reach the $203 per share. Or what happened, for example, if the market is willing to pay a higher multiple, like 20, so the intrinsic value could be $225 per share here. So given the fact that we really want to be more conservative here, I like to consider just 12 in order to incorporate a more margin of safety here. And then I would say that 94.79 is a good price. If you decided to get into this company and pay the current price of $95 per share, you need to take into account that you are really acquiring a really good company at a very attractive price, but you need to consider that the stock price of Alibaba could be subject of high volatility here in the short term. So it means that even if the price of right now of $95 per share is attractive, the price could goes down to, I don't know, to $60 per share, to $40 per share, to $30 per share. We don't know, honestly. This happens because the main driver of the stock market price in the short term is not the performance of the business. It is really the news, the conflict between Ukraine and Russia, there are more regulations in China, the delisting risk of the different kind of things that could affect in the short term stock market price of Alibaba. But in the end, in the long term, the main driver of any stock market price is the performance of the business behind the stock here. So that's why this is something that you need to take into account if you want to get into this stock here. So this is the second methodology here. We will assume the DCF, the discounted cash flow methodology here. The main assumption here is that we will hold this company more than 5 years here. It could be 10 years, it could be 15 years. So this is important because the time horizon that we are considering here is the main difference between this method and the previous method that I just shown to you here. Now, we will consider the outstanding number of shares here, and then we have the free cash flow over revenues. I will consider the same 25%, and then we will just incorporate our previous assumption with respect to the forecast for the sales growth here from the year 2022 to the year 2026. Given the fact that we have the official numbers for the year 2021, we could calculate the projected revenues for each of these years here until the year 2026 here. And then we will just multiply each of these projected revenues by this metric, the free cash flow over revenue of 25%, and then we will estimate our free cash flow in each of the years from the year 2022 to the year 2026 here. Given the fact that we will need to consider the perpetuity here, the first thing that we will need to do is to consider the first term of this sequence here that we are not putting here, because the main purpose is to calculate the present value of all the sequence here of the perpetuity here. So I will just consider here a 3% of growth here the year 2027 respect to the year 2020 2026. Look at the growth here in each of these years. In free cash flow, really 16%, 15%, 14%, 40%. This is because of the construction here. This is the same as in the sales growth rates here. But we are really being conservative here, because look at this, the average growth in free cash flow in the past 6 years delivered by Alibaba, 34% here. But we need to be really more conservative in the perpetuity, because we are just talking about the very long term here. In order to calculate the present value of all these subsequent free cash flow, we will need to take the first number of this sequence of the perpetuity, and we will need to divide it by the discounted rate that we are assuming here for a Chinese company of 15% here, and then we will need to subtract the growth that we are considering for each of the free cash flow in this sequence here. Just 3% annual growth rate in free cash flow year by year here for all this sequence. So this is the present value, which is located here in the year 2026, but we are right now in the year 2022. So we will need to calculate the present value, just again a present value for this number here, because our purpose is to calculate the present value here in the year 2022. So the thing is, we will need to divide this 1 plus the discounted rate here and an exponent 5, because there is 5 years here of difference. We will take the present value of all these cash flow here from the year 2022 to the year 2026. To calculate the enterprise value here, we will need to just add all the perpetuity and the present value of all these cash flow here. We will need to add the 51.4 billion in cash in the balance sheet, and then we will need to subtract the total debt of the company here, and then we will need to divide just this enterprise value by the outstanding number of shares, and we have $173 per share here. This is really interesting because it is higher than intrinsic value calculated in our previous methodology here. But something that you need to take into account is that we are talking about a longer period to hold this company. This is something that you need to take into account here. We are considering that you will hold this company for more than 5 years here, 6 years, 7 years, 10 years, 15 years. Okay, so it is understandable that the intrinsic value per share under these conditions could be higher. Something really important to notice is that we could change some of our assumptions in order to see how the intrinsic value per share could change here. For example, what happened if really Alibaba is able to deliver 5% of growth in our perpetuity in this sequence in each of these years, 5% in free cash flow of growth here. Look at this, how our results will change here. $192.46 per share, which is really good. What happened, for example, if Alibaba really ends up delivering 10% of growth in free cash flow since the year 2026 onward? So look at this, $308.6 per share here. So this is really interesting, but we need to incorporate in a way our margin of safety here. So we will just consider 3%. I feel comfortable with this. What happened, for example, if the cash flow of Alibaba ends up being, I don't know, 20%? Well, the intrinsic value will be lower here, because you are considering a lower production of free cash flow respect to revenues. But what happened, for example, if Alibaba recovers a better free cash flow here over revenues? Well, the thing could be even better here. So that's why we need to be really conservative here when we are making calculation or projections for the very long term here. But something that you need to take into account is that if you decided to get in this company to pay a price, the current price is just something like $94, $95 per share here. It is a good price for the very long term. But if you want to get into this company, you need to have a longer time horizon here for your investment. In this case, for example, if you want to take advantage of an intrinsic value per share of at least $173 per share, it is important that you hold this company for the very long term, for more than 5 years. It could be 10 years, it could be 15 years, because that's the only way in which you will give the chance that the performance of the company represent the main driver of the stock market price in the long term. Right now, the price is affected by other factors. The news, for example, of the conflict between Ukraine and Russia, the potential more regulations to the company, the economic situation of China. I mean, there are lots of things that could affect right now in the short term the stock market price of this company. So if you are getting into this company right now, are really paying an attractive price, but you need to be prepared in your psychology, because the price is really right now is subject of so high volatility. I mean, the price could go, for example, to $60 per share, to $40 per share. We don't know, honestly. But of course, in the long term, the main driver of the stock market price is most of the time the performance of the company, and in this case the performance of the company is really has been really good here, despite the fact that there is a strong competition. Really, the company has interesting sources of future growth here, and the company is really well managed by rock solid management. So this is the kind of thing that you need to take into account if you want to get into Alibaba. Now in this part I will talk about a little bit, I will make a brief comment respect to how the Ant's IPO could be a potential catalyzer for Alibaba's intrinsic value. I will need to incorporate as well the donations for the common prosperity, which was a policy released by the Chinese regulators in the year 2021. So I feel curious respect to how both variables could influence in the intrinsic value of this company here. Look at this. In the year 2021, in October 2020, it was supposed that the Ant's IPO would be something like $350 billion here, and if you divide this number by the outstanding number of shares, this would be $133.62 per share, and if you multiply this number by the 33.3% of participation of Alibaba in Ant, this is $44.54 per share, and this number should be included in the valuation of Alibaba. Look at this, is an important catalyzer here, and look at this, that explains why the stock market price of Alibaba experienced a surge in the months before the Ant's IPO in October 2020, I mean before the regulations. But something really important to notice here is that, I mean, I don't know when a second IPO of Ant could happen, because you know that Ant is in an ongoing process to be transformed to a financial entity, and we don't know when that second IPO could happen. I mean, it could be in the next year, it could be in 2 years, it could be in 3 years, in 4 years. We don't know, honestly, and we don't know how the worth of this important subsidiary could change after the regulations. But the fact that I like to be really conservative here, I would assume that I will put myself in the worst scenario here. I will assume that the valuation of Ant will decrease something like 90%. Okay, it's enormously. So I'm assuming this. I mean, I don't have any information respect to the how could be the new worth of Ant and after regulation, but I'm assuming, and I'm putting myself in the worst case scenario here. Okay, that could be $4.45 per share of the valuation of Ant. This is a number that could be added to the intrinsic value of Alibaba here. And then what happened, for example, now to incorporate the donations for the Common Prosperity Program here, and it requires a company like Alibaba to pay in installments until the year, in equal installments in each of the years until the year 2025 here. So the only thing that I'm doing really is to divide this all these numbers, I mean this number by 5. Okay, it was supposed that a first installment has been paid in the year 2021, so I will just consider here the 4 remaining years, the 4 remaining installments here, and I will just consider to calculate the present value for each of these installments here. So I will consider, of course, the same discounted rate, 15% here, each of the following installments payment. Now the only thing that we need to do is to sum all of this present value here. This is the present value for donations here right now in the year 2022, and then I will need to divide this just by the outstanding number of shares here, and then we will have the present value donations per share here. Okay, this is the number that will need to be subtracted from the intrinsic value of Alibaba. You notice here that if this intrinsic value will include here that we just previously calculated, we just add the participation of Ant in the worst case scenario, and we will just subtract the donation here for the Common Prosperity here. So you can notice that there is not so much difference between this new intrinsic value and the previous intrinsic value that we just calculated previously here. So what happened, for example, if after the regulations of Ant and after the ongoing processing which Ant is subject right now by the regulators, the worth end up just declining just 20%. I mean, this would be amazing for us as a long-term holders, because look at this, how much this participation of Ant should be added to the intrinsic value of Alibaba here. So there could be important catalyzers for long-term holders. If you are considering investing in Alibaba and you just have 2 or 3 years of time horizon for your investment, Alibaba is not the stock for you. This is a stock for investors who are thinking beyond 5 years, 5, 6, 7, or even 10 years. And in that way, there could be opportunities for all potential catalyzers, like for example the case of the Ant Group would release a second IPO, and of course that the valuation would not be affected so much, and in that way the participation or the catalyzers could be really important for the intrinsic value of Alibaba here. And in the case of the donations here, we don't need to be worried about this, because really impact in the donation really are not really meaningful to the intrinsic value of Alibaba. And something that is really important is that the common prosperity really a donation demanded by the government, but really all that money will be used to increase the investment in certain critical sectors that of course could end up affecting in a positive way the consumption in the economy. If the consumption in the economy is increasing, that could be an important catalyzer for the growth prospects of Alibaba. Now, in this part, I will talk about the intangibles of this company. I mean, this is the kind of things that are frequently overlooked by the market, and probably most likely this is the kind of thing that attract a super investor like Charlie Munger here. Look at this, the intangibles and the culture organization. I mean, how strong they are extremely important to build up the strengthening of the company, to build up the resilience of a business model whenever it is facing potential threats, regulations, stronger competition, and so forth. That's why it is extremely important to understand intangibles in this case. Jack Ma was the main responsible of the culture organization, because he instilled all these values since the very 1999. Look at this, what he has said some years ago. He says, when Alibaba was founded in 1999, our goal was to build a company that make China and the world proud, and one that could across 3 centuries to last 102 years. However, we all knew that no one could stay with the company for 102 years. And sustainable Alibaba would have to be built on sound governance, culture or centric philosophy, and consistency in developing talent here. Look at this, how important it is, the culture organization here, the culture-centric philosophy here, to fulfill the main goal of Alibaba to last more than 102 years. Look at this, the culture in Alibaba is established that first, the client is first, the second are the employees, and the third are the shareholders. And in that way, more value is created to the shareholders. So it is important to understand that Alibaba is working to continuously improving the experience for the client here. And in that way, they are strengthening the engagement with the active users, they are strengthening the engagement with the clients here. And that's how they are reinforcing their business model for the long term here. And look at this, in the case of the values here, the client is first, it is promoted the teamwork, and of course they embrace the challenge with integrity and commitment here. Look at this, how important it is, because the regulations started in October 2020. I was not concerned about that fact. I mean, most people in the market was concerned about how that could affect the growth prospects of a company like Alibaba, all those regulations. And I was sure that yes, it could affect in the short term, but in the long term, it won't affect anything, all the regulations. The company will be able to adapt its operations, and then they will start to deliver value again here. Something that is critical here, that the shareholders, it doesn't mean that the shareholders are the last here. According to the vision of Jack Ma here, the only way to create more value for the shareholders is to put the client as first in the list here. That's the only way to generate sustainable value for the shareholders in the long term here. Now, in order to promote this strong culture organization, although all those values, it is important to understand that in Alibaba there is a strong human resources department here. The human resources department in Alibaba has an enormous power here to instill all these kind of values in all the parts and different departments of the organization here. So really there is a strong weight of the human resources department of Alibaba to promote strongly the culture and ideology within the company here. And one of the proof is that I just found some information about it. They have a handbook of more than 1,000 pages that are sent to the new employees to understand more about all this culture and vision of the company. And then, well, the human resources department has a sophisticated database that match accurately productivity promotions and wage increases here. So it is really important because there won't be colleagues that will feel unsatisfied with their job in Alibaba, because in this case, if you really work and you increase your productivity, you are increasing your chances to be promoted and of course to have wage increases in the company here. So this is something that create a really good environment in which the employees here are working to be better, even better and better, and of course that would benefit the company here to deliver more and more value to its customers. Some information that I just found with respect to how, for example, the human resources really help to the employees in Alibaba. Like any other company, it is established a certain set of annual goals for each of the employees. Your annual goals are divided by phases, and you will need to comply your goals in each of the phases to reach your annual goal here. So it is like Alibaba really helps you to establish, for example, what should be your daily goals if you want to achieve your annual goals. This is something really important to encourage the employees to achieve or surpass their annual goals in the company. And another important point that I just found is there are frequent staff turnovers. I mean, whether you like it or not, if you are working for Alibaba, you will be working different departments in different regions in China in order to understand different products, different services that are offered by the company, and in that way you will have a better picture about the ecosystem within Alibaba, because in other companies there are people who are working in the same department for several years here, so their contribution is rather limited. But in this case, what the human resources is really doing is to instill a wider picture in their minds of each of these employees to give them the incentives to launch new ideas that create value that create value for the clients, and in that way more value will be created for the shareholders in the long term here. Another important point that I just found here is that how Alibaba really incentivizes its employees. For example, I just found information that Alibaba celebrates employees' marriages, pay the accommodations of the relatives who comes from different regions in China. Alibaba pays for the food. There are other things that I just found. For example, that Alibaba finance up to $50,000 at zero interest rate for housing. Well, this is information from 2016, 2017. So most likely there are more things that Alibaba has developed to incentivize its employees to, of course, to develop and strengthen the engagement of the employees with the company, which is something extremely important here. And probably you are thinking yourself, yes, okay, there are values like any other company. I mean, you will see all the values written in a paper that is put in the wall of all the offices in the head office in China. But the evidence that this is strong is really, really strong, that really influence in the employees' behavior, is that there are several employees, former employees, that have worked several years in the company, in Alibaba, and then after several years they quit their jobs and to start their entrepreneurship. Look at this in the case of the Chen Kui here, founder of Jiangdu.com here, Chen Xi, founder of Lava Radio here, Gu Daju, founder of www.bong.cn, Lei Ji, founder of 3bar, Lan Jian, founder of this thing, 1kf.com, and so on. Look at this, and the list is even bigger as years pass, because, well, there are more and more employees who really are instilled with all these values, and they feel the necessity to start their entrepreneurship. I mean, this is really something that I really impressed here. What are the risks associated with Alibaba really? And I want to make a comment briefly about this because it has been mentioned so much about this risk in the last 2 years that we could discover what could be the potential mitigations for all of them in the long term here. Look at this. In the case of the delisting, you need to think yourself, if the delisting risk is really associated to the performance of the company? No, it is not associated with the performance of the company. Particularly if you are investing in a company like Alibaba, it's because you are investing for the very long term. Case in which there is a delisting, of course there could be a massive sell-off here. But given the fact that you are a long-term holder, you shouldn't care so much about that, okay? But of course, what is the probability that something like that could happen to Alibaba is really low. according to last news, really there is a strong intention by the Chinese regulators to comply with the requirements set by the US regulators. And this is something important because it is likely that there could be a future agreement with respect to this matter here. The Chinese regulators are really interested in that the Chinese company continues being listed in the most liquid market in the world. So this is important to them. In the case of the variable interest entity structure, well, most of the bearish analysts were saying that this is something that has potential risk here because China could declare this as an illegal form. According to recent news here, the Chinese regulators has said that they will support this structure because this is the only way to trade the shares of their companies in the US market. So this is something unlikely that they will declare something like that illegal here, because with that they will destroy completely the confidence of the investment community and the company. The most important thing for them is that the companies in China will not be able to raise more capital from the stock market. So this is something critical for them. So the fee structure really is low as well. The case of a recession here, the economic recession, well, any country could face economic recession. Even the US could face a potential recession in the next years. And so if you are not investing in Alibaba just because of the economic recession, that is not a good argument, because that means that you shouldn't have any stock from any other country here, because all the countries will face economic recession at some point in the future. This is part of the economic cycle that is something that was happening in the last 100 years, 200 years. So it is impossible to find a country that will not face an economic recession. But anyway, when we have an economic recession, really we need to stick to companies that have resilient business model, because those are the companies that will thrive even in those events, and Alibaba is just one of them. In the case of the regulations and crackdowns, well, this is just something that I really, in my humble view, I don't care the regulations and crackdowns, really, because you need to remember that China really is an emerging market. It's not a developed market. So they needed at some point to put new regulations to the tech sector, which is something that is happening in the West, in Europe or in the US. They have strong regulations for the tech sector. So nobody was complaining about them. But then if China wants to put regulations to strengthen its economy, to make it more sustainable for the long term, yes, I mean, I think that it's understandable for the Chinese economy, for the Chinese government to put these kind of regulations here. It is because this creates more sustainability in the economy of China in the end. So really, and given the fact that, as I explained to you before, Alibaba is well prepared to embrace any sort of challenge, any sort of regulations, a stronger competition and so forth, because of the strong and instilled values and mission and vision, a strong cultural organization within the company instilled by Jack Ma here. So as you have seen after all this comprehensive analysis of Alibaba here, is that there are different things that are beyond the numbers of Alibaba here. Alibaba is not only an undervalued stock. The company really has something special with respect to the core values within the company that were instilled by Jack Ma since the very beginning. So this is something that make me feel comfortable with the company, with the stock to hold for many years here. And this is something that I haven't found in other companies that are undervalued right now. I mean, I don't trust so much in the management, and I'm not sure about the culture values of those companies. But in this case, surprisingly, really, I feel really attracted to the core values of this company, and the fact that not only the company is undervalued, but of course that Daniel Zhang, which was the first choice of Jack Ma to be the CEO of this company, has demonstrated to make an outstanding job in the last years, adding more value to the company, reinforcing the business model, and of course reinforcing the core values instilled by Jack Ma here. So this is not a stock that is for everyone here. If you are expecting returns for the next year, or for the next 2 years, or even for the next 3 years, this is not a stock for you. This is a stock for investors who are thinking in the very long term, beyond 5 years, 6 years, 7 years, 10 years, 15 years. So it is not a surprise that a super investor like Charlie Munger decided to bet heavily in this company, because he likes to hold companies for decades. All the holding that he has in the daily journals had several years. So he wanted to make sure that the company that he was choosing has strong values, is undervalued, and it has, of course, this resilient business model. I hope that you really have enjoyed this video. Please put a like if you consider that this is a video that is adding value to your investment knowledge. This is not a financial advice, this is just for educational purposes. So consider to subscribe if you think that this is a channel that could add value to your investment knowledge here. I will continuously delivering more and more information with respect to different concepts, with respect to different companies, always since the value investing philosophy point of view. So I hope to see you in the next video. Peace.